Good afternoon, everyone. This is Henry Gambell with simpleroptions.com, and in today's free video, I wanted to discuss some ideas with you in Tesla. Tesla had a very nice sell-off on Tuesday, and the main thing that I'm focusing on right here is the fact that we have another daily squeeze in play. Now, of course, anything can happen at any moment, but when I come back and I compare previous price action in relationship to previous squeezes, I think we see a pretty clean pattern that each time something like that forms, we get another nice shove back down to the downside, and that's what I'm looking for from here, for another continuation lower. So a couple of ways to look at playing this. The first thing that I look at when we come back over into our options chain, and you look at today's options statistics here in Thinkorswim, the IV rank, or implied volatility in relation to itself for the past 52 weeks, is very low. So with it being in that lower percentile, you really want to focus on a little bit more directional play because you're not having to pay as much for the premium. So with that thought in mind, I like coming in and looking at the idea that the 200 is of course where we failed from, so I like the potential of buying that as our option, and then with a $12 expected move from 190, I'm thinking that could get us back down into about 180 or so. So the expected move, right there in line with what would take us back down into the previous lows, because if we're trading 190, the expected move is right around $10, well, that's going to take us right down into that. Now you can see I'm giving that some leniency, but in reality, if you're talking about $12 and you're talking about 178 being the technical level there, at the end of the day, I think it helps create a pretty clean vertical. So if we were to buy the vertical, picking up the 200, and then selling the 180 to create a cushion for this, it creates about a 1-to-1 risk-reward ratio. And if I could pick this up during tomorrow's session for a $10 debit, I'm risking 1 to make 1. And then if we sit here and continue to consolidate at 190, that's my break-even point. So if it stays and trades sideways, I'll break even. If it moves lower, I've got a decent risk-reward ratio, and that's the way that I'm going to be looking to play Tesla over the course of the next 16 days. Now that's a relatively aggressive way of playing it. You know, you've got to be pretty much right over the course of the next 16 days. If you wanted to step out further, I think this would be another perfectly fine place to do this trade, though it may take a little bit longer to come to fruition. And I may also look at widening out my strikes a little bit to give myself a better probability of profit if we do break the fresh lows. So if you want to do that in the Decembers, I would stick to looking at it 20 wide. If you move out into January, doing a 25 or 30 wide would work out just fine as well. And then we look for Tesla to break the 177 low as we head into the end of this year and the first part of 2017. So I hope that helps, gives you guys a couple different things to look for from Tesla in the coming sessions. And then I also wanted to make sure that if you are not a member of Simpler Options, I wanted to let you know that we are running a trial for $7. So if you'd like to check it out for 30 days, it gives you a review of everything that you'll get from that. And if you want to check it out for 30 days, it's a good opportunity to do that. So I hope you found this helpful. If there's anything else I can do for you, please let me know, and we'll see you at the next free video.